Hello everyone, this is Jennifer. So we're going to look into some of the problems and solutions of the various concepts. So we're going to work out a problem on plant, property and equipment. So before that, I would like to talk about this particular format. So the initial cost of property, plant and equipment can be determined as under. So how do you basically find out the initial cost? So it you're supposed to take up your purchase price, then add all the duties or taxes, then you're supposed to add if any cost is incurred for bringing the asset to the working condition in the site. Example could be a site preparation cost, handling cost, initial delivery cost, installation cost, assembling cost, professional cost if there are costs incurred by any person for installing or something like that, or like the architect or the engineer fees, everything you will add. Then you will deduct if any trade discounts or rebates are there, then you'll get your initial cost. So we'll look into one of the problems. RK Limited contracted with a supplier to purchase a machinery to be installed in its organization in 2 months. Special foundations were required for the plant, which were to be prepared within the supply lead time. The cost of site preparation and laying special foundation is 31,600. So this is a site preparation cost. So you will add it. The machine was purchased. So the purchase price is 38 lakh 68,000 and VAT was charged at 4% on the invoice. So 38 lakh 60,000 into 4% is your VAT. So transportation charges incurred to bring the machine into factory is 10,800. So these are also the initial cost incurred in bringing out the asset to the working condition in the site. Like as I told, these are the directly attributable cost of bringing the asset to working condition for its intended use. So this comes under your assembly cost. An architect was engaged at a fees of 5,000 to supervise machine installation at factory premises. So this is also the directly attributable cost of bringing the asset to working condition for its intended use. This is the professional fees. You are required to calculate the capitalization cost of the machine. Capitalization is cost is nothing but the cost included in knowing the value of the asset or the machinery. Assume that the RK Limited is not entitled for input VAT credit. So we will calculate the capitalization cost or the value of the asset. So you start with the purchase price, which is 38 lakh 60,000. You add your sales tax. So any taxes are there, you add it, which is 4%. 38 lakh 60,000 into 4%, which is 1 lakh 54,400. Then you add all the other costs, which is your site preparation cost, which they have given in the question, which is 31,600. Then the initial delivery and handling cost, which is 10,800, and the professional fees, which is 5,000. So if you total it up, you get 40 lakh 61,800. So we are looking into our next question, which is about the inventory. Okay, so Previn Limited deals in 5 products A, B, C, D and E, which is neither similar nor interchangeable. For the year end 31st March, the historical and net realizable value of the items of closing stock are determined as follows. So historical cost is nothing but the actual or the original cost incurred in buying the asset, whereas the net realizable value is the value of the asset that can be realized upon the sale of the asset. So when you are selling it, what value can be realized? So they have given the both the values and they have told us to find out the closing stock value. So how do you basically find out the closing stock value is, there are 5 items A, B, C, D and E, and we have the historical cost given and we have the net realizable value given. So how do you value it? historical cost or net realizable value, whichever is less, we consider that to be the value of the closing stock. So if you see for item A, 5,70,000 is historical cost, 4,75,000 is the net realizable value. So the valuation will be 4,75,000 because that is less compared to your historical cost. In the same way, we will do for all the items and we will total it up and we will get 23,29,000, which is nothing but our inventory value. So our next question is going to be on lease agreement. So compute the minimum lease payments in the following independent situations, where Suresh and Ramesh are the lessor and lessee. So Suresh is a lessor and Ramesh is a lessee. Monthly lease rent, they have told for the first instant is 25,000, lease term is 32,000. Rajesh, a third party, provides a guarantee to Suresh that 55,000 will be paid as residual value. So residual value is the value of an asset at the end of the lease term, or it all can also be termed as the value which can be bought, or which the asset can be bought at the end of the lease. So the third party provides a guarantee to Suresh that he will pay the residual value to be 55,000. You are supposed to compute the minimum lease payments. So at the first instance, so what is the total lease rent payable? 25,000 into 32 months, which is 8 lakhs. And what is the residual value guaranteed by the third party? 55,000. So the minimum lease payment for the lessor is 8,55,000, the total, and for the lessee is again 8,55,000. So second instant, which they have told, minimum lease rent 15,000 for 48 months, together with 2.5% of the sales revenue per annum. Rajesh guarantees to pay Suresh rupees 10,000 as residual value. So the total lease rent payable is 15,000 into 48 months, which is 7,20,000, and the residual value guaranteed by the lessee is 10,000. So total is 7,30,000. So for lessor is 7,30,000 and for lessee is 7,30,000. And the third instant is monthly lease rent is 90,000 for 18 months. Ramesh has an option to. So first we'll find out the lease payment. So total lease rent payable is 90,000 into 18 months, which is 16,20,000. And Ramesh has an option to purchase the asset at the end at a certain date for 2 lakhs. But what is the fair value of the asset? 4,20,000. So the purchase option price or the fair value option price is exercised at whichever amount is less. So 2 lakhs is Ramesh telling, but 4,20,000 is the value of the asset. So we will consider 2 lakhs, which is whichever is lesser the amount. So for the lesser is 16 lakhs plus 2 lakhs, which is 18,20,000, and for lessee again it is 18,20,000. So our next question under lease agreement is Ravi Limited has taken machinery on lease from Rama Limited. The information is as under. Lease term is 4 years. The fair value is 20 lakhs. Lease rent is 6,25,000 at the end of year. Guaranteed residual value is 1,25,000. Expected residual value is 3,75,000. Implicit interest rate is 15%, and calculate the value of the lease liability. So they have told us to calculate the value of the lease liability with giving our discount rate and interest rate. So calculation of present value of minimum lease payment. So for how many years they have told? For 4 years. So we have year 1, year 2, year 3 and year 4. So for 4 years we have the lease rent given by the lessee. So annual lease rent is, how much have they told? 6,25,000. So the present value they have given for each year. So we take up the present value and we multiply it, and we get the present value for all the 4 years. After 4 years, they have told the guaranteed lease residual value is 1,25,000. So you take 1,25,000, the fourth year present value is 0.5718. So when you multiply it, you get the amount. When you total it up, you get 18,55,851. So they have told us to calculate the value of the liability. So the fair value of the asset, as I told in the previous question, the fair value of the asset is given in the question to be 20 lakhs. But after the lease agreement, we get the amount to be 18,55,851, which is nothing but the present value of minimum lease payment. So whichever is lower in this, that will be considered as value of lease liability. So 18,55,851. Our next question is under lease is Ranjit Limited has taken an asset on lease from Yashwant Limited for a period of 3 years. Annual lease rentals are 6 lakhs. So every year lease rental that they are payable is 6 lakhs. The residual value guaranteed is 2 lakhs. Whereas Yashwant Limited expects the estimated salvage value to be 5 lakhs, meaning to tell he wants the residual value to be 5 lakhs, Yashwant Limited, but whereas Ranjit has guaranteed to pay 2 lakhs at the end of the lease term. If the fair value of the asset at the lease inception is 15 lease inception is 15 lakhs and the interest rate implicit in the lease is 12%. Compute the net investment in the lease from the point of view of Yashwant Limited and the annual finance income. So they have given the discount factor. First, let us find out the present value of the minimum lease payments. So how many years? 4 years. How many years is the lease? 3 years. So 3 years lease payments. So 6 lakhs into the present value factor they have given for 12%. So first year, second year, third year, when you multiply, you get the present value. So the last year, if you see, there are two concepts, which is the guaranteed residual value and the unguaranteed residual value. Guaranteed residual value is 2 lakhs. He has told he is going to pay 2 lakhs. So when we put the present value factor, we get 1,42,000 and change. And there's an unguaranteed residual value, meaning to tell Yashwant wants them to pay 5 lakhs, but they are guaranteeing to pay 2 lakhs. So unguaranteed residual value is equal to total residual value minus guaranteed residual value. So 5 lakhs minus 2 lakhs, which is 3 lakhs. So again you multiply into the present value factor and you get the present value. So your total of the present value of minimum lease payments is found out. So our next calculation is calculation of net investment in lease. So what is the investment in lease? So we start with minimum lease payment 6 lakhs into 3 years, 18 lakhs. You add the guaranteed residual value, which is 2 lakhs. So the minimum lease payment from the viewpoint of the lessor, that is Ranjit, is 20 lakhs. Add unguaranteed residual value, meaning to tell the residual value which the Yashwant Limited expects. So that is 5 lakhs minus 2 lakhs, which is 3 lakhs. So gross investment in the lease is 23 lakhs. So total up 23 lakhs minus your present value of minimum lease payment plus gross residual value and guaranteed residual value and unguaranteed residual value, which we already found out, which is 17,97,040. So the unearned income is 5,02,960. So this is how you will find it out. So the statement showing recognition of finance income by the lessor from the point of view of the lessor. So we start with statement showing recognition of finance income by lessor. So here there are 3 years net investment in lease. So you start with the net investment in lease, which we found out 17,97,040. The finance income at 12%, they have told the interest to be 12%. So finance income at 12%, 17,97,040 into 12%, you get 2,15,645. So the total lease payment received by the lessor is, so how much is the lease payment received by the lessor? So 6 lakhs each year. So 6 lakhs. Balance reduction in principal is 6 lakhs minus 2,15,645, which is 3,84,355. So when we minus net investment in lease with the principal amount, you get the second year's net investment in lease. The same way, net investment into the finance income percentage, the total lease amount remains the same. Balance reduction is 6 lakhs minus 1,69,522, which is 4,30,478. The third year is 14 lakhs 12,685 minus the principal amount, how much is to be deducted. So you get your net investment in lease amount. Again you multiply into the percentage and you get the total lease payment. So balance reduction in principal is 6 lakhs minus 1 lakh 17,865, which is 4,82,135. So 5 lakhs and 72 is your last year lease investment and minus your lease payment received, which is nothing but your guaranteed residual value plus unguaranteed residual value. So if you see, there is 0% or zero amount in the reduction in principal because it is rounded off. So this are the questions and answers for lease payments. So thank you everyone.